Welcome to Breaking News to Trading Moves.
It is great to be here.
So we have a very specific earnings report to look at today. To really connect the dots on what is happening out there, it comes from a company called FTAI Aviation. The ticker is FTAI.
Right, FTAI. They reported their quarterly numbers recently, and the headline is pretty straightforward. They missed expectations.
They missed the number. And, usually we might just look at the stock price reaction and just move on.
Sure.
But the goal here is to look at the logic behind that reaction. We want to see exactly who wins and who loses based on the data coming out of this specific report.
Exactly. We aren't here to over-dramatize it. It is just a data point, but it is a data point that clarifies the current state of the market. It really highlights the tension between the aerospace sector and the narrative around, AI and power consumption.
It is a unique combination. You have airplanes and you have data centers.
Yeah.
And somehow, this one report from FTAI touches on both of those things.
It does. So we're going to look at the event itself, and then we will categorize the rest of the market into winners and losers based purely on the mechanics of the trade.
Let's start with the company in the spotlight then. FTAI Aviation, ticker FTAI. What exactly happened with their numbers?
Well, they reported financial results that were below what Wall Street analysts had predicted. The revenue and the earnings just didn't quite hit the mark.
And the stock took a hit because of it.
It did. And to really understand why, you have to look at the valuation context. You have to look at how the stock was priced right before the news came out.
We often hear the phrase, priced for perfection. Is that what we are seeing here?
That is a very fair description. When a stock has had a strong run, the valuation expands. Investors are paying a premium because they expect flawless execution.
Right.
They expect the company to beat estimates every single time.
So there's really no room for error at that level.
Very little. When a company is priced that high, any deviation from the expected path can trigger a sell-off. It is not necessarily that the core business is broken. It is just that the price was assuming a better result than what was actually delivered.
So it acts as a valuation reset.
Correct. But there's a nuance here that is definitely worth noting. Even though they missed the number for the quarter, management was very clear about their future outlook.
They didn't lower their targets, did they?
No, they didn't. In fact, they emphasized that their longer-term targets are stronger. They are looking out to 2026 and saying the outlook has actually improved.
So the message they're trying to send is, we hit a bump, but the road ahead is completely clear.
That is the pitch.
Yeah.
And they specifically highlighted their power initiative.
And this is where the second theme comes in, this power initiative.
Yes. FTAI has exposure to power generation assets. By talking about this right now, they are reminding investors that they are not just an aviation company.
They want to be part of the narrative surrounding power demand.
It is a smart move from management. Everyone knows that data centers and AI require massive amounts of electricity. So by emphasizing their role in that space, FTAI is giving investors a reason to stay engaged, even amidst an earnings miss.
It bridges the gap. It says to the market, we missed the aviation number, but look at this other opportunity we have.
It creates a buffer. But as we saw, the market still reacted to the miss. And that reaction gives us a roadmap to look at other sectors to see how the logic flows.
Let's move to the winners then. Based on the logic of this report, who actually benefits?
The first group of winners is in the aerospace aftermarket.
The companies that sell the parts and the services.
Correct. The logic here is completely driven by scarcity. The aviation industry is facing a severe shortage of working engines and new aircraft.
We know that production from the big makers has been slow.
It has been very slow. Airlines simply cannot get the new planes they ordered on time. So what do? They have to keep their existing fleets flying.
They have to extend the life of the older planes they already have.
Exactly. And when you fly an older plane, it needs more maintenance. It needs more parts.
It is like driving an old car. Things break the longer you keep it on the road.
That is it exactly. And because the airlines have no choice, they have to keep these planes in the air to meet passenger demand. The demand for replacement parts is incredibly high.
And I assume the pricing environment is very favorable for the suppliers in that situation.
It is. These are high-margin services to begin with. The suppliers have all the leverage right now. If an airline needs a specific part to fly a revenue-generating asset, they will pay whatever it costs for it.
Let's look at the specific tickers. The first one in this winner category is Heico.
Ticker HEI.
HEI. Tell us about them.
Heico is a major player here. They are known for making replacement parts that are alternatives to the original equipment manufacturers.
So they are kind of like the generic option?
In a way, yes, but you have to remember these are highly engineered, fully FAA-approved parts. When airlines want to save money, or more importantly, right now, when the original manufacturer can't supply the part fast enough, they turn to Heico.
And in a world where everyone is scrambling for parts to keep older planes in the air, that is an exceptional position to be in.
It is. Volume is high, and they act as a critical release valve for the pressure building up in the industry.
The next winner is TransDigm Group.
Ticker TDG.
TDG.
TransDigm has a very specific business model. They focus almost entirely on proprietary aerospace parts.
What does that mean in this practical context?
It means they actually own the design and the manufacturing rights for very specific essential components. Often, they are the sole source supplier for a given part.
So if you need that specific widget for your engine, you literally have to buy it from them.
You have absolutely no other option, and that gives them tremendous pricing power. They are often compared to a private equity firm by analysts because of how they acquire these niche businesses and then rigorously optimize the pricing.
So they are a direct, clear beneficiary of the need to keep these older planes flying.
Absolutely. Every time an older plane goes into the shop for heavy maintenance, there is a very good chance it needs a TransDigm part to get back in the air.
The third name we have in this aftermarket group is RTX.
Ticker RTX.
RTX.
This is the company formerly known as Raytheon. They own Pratt & Whitney and Collins Aerospace. They are a massive original equipment manufacturer.
But they are listed as a winner here, not a loser. Why is that?
Because of their aftermarket business, they have a huge installed base of engines out there in the world. And right now, those engines are flying more hours because of the capacity constraints.
So they make their money on the long-term service contracts and selling the spare parts.
Correct. Even if their new engine production is facing challenges or delays, the service side is a total cash cow. The more the planes fly, the more RTX earns on the back-end maintenance.
So the core logic for this group, HEI, TDG, and RTX, is that the scarcity of new planes drives intense demand for parts to fix the old planes.
That is the core thesis. Scarcity at the manufacturer level creates a windfall for the aftermarket.
Let's move over to the second group of winners. This takes us to the other theme FTAI management mentioned, the power sector.
Right, specifically data center power and electrical infrastructure.
The logic here connects straight back to the AI narrative.
It does. The build-out of data centers and AI capabilities is increasingly constrained by the sheer availability of power. You can't just build a massive facility anywhere you want anymore.
You need access to the grid.
You need access to the grid, and you need the specialized equipment to handle that massive electrical load.
And FTAI's management reinforced this idea on their call.
Yes, by pivoting to talk up their power initiative, they confirmed that this is a top priority. It reinforces the multi-year demand trend we are seeing for power infrastructure.
So to connect the dots, who are the specific winners in this space?
The companies that provide the physical equipment and services to make it happen. The first one is Eaton.
Ticker ETN.
Ticker ETN. Eaton is an absolute giant in power management. They make the switchgear, the transformers, the circuit breakers.
The actual hardware of the grid.
The essential hardware. If you are building a data center, you need Eaton's equipment to manage the electricity safely and efficiently. You can't operate without it.
And demand for that equipment is running hot.
It is running very hot. Order backlogs for this kind of heavy electrical equipment are stretching out for years right now.
The next one on the list is Vertiv.
Ticker VRT.
Vertiv focuses on the critical environment inside the data center itself, specifically power distribution and cooling technology.
Why is cooling technology so critical to this narrative?
Because AI chips run hot, much hotter than traditional server racks. You need highly advanced cooling systems just to keep them operational and prevent thermal throttling. Vertiv is a recognized leader in that specific technology.
So as the chips get more powerful and draw more wattage, Vertiv becomes even more important to the infrastructure. That is the market view. They are a direct derivative play on the underlying AI chip demand.
And the third winner here is Quanta Services.
Ticker PWR.
PWR.
Quanta is the company that actually builds the physical infrastructure. They do the heavy transmission lines, they build the substations, they handle the complex grid modernization projects.
They are the builders on the ground.
They are the specialized labor and the engineering expertise. If a utility needs to connect a new power plant to a newly built data center, Quanta is very often the contractor out there doing the actual work.
So we have the heavy equipment from ETN, the specialized cooling systems from VRT, and the physical construction from PWR.
All supported and reinforced by the narrative that raw power is the ultimate bottleneck for AI expansion.
Let's transition to the third group of winners. This brings us back to aviation. But this time, it is about ownership, aircraft leasing and services.
Yes, this is a sector that benefits directly from the physical shortage of aircraft we talked about earlier.
Explain the logic for us.
It all comes down to basic supply and demand. If the major airlines cannot buy new planes from the manufacturers because of delays, they still have to meet their passenger schedules, so they have to lease them.
So the sheer demand for leased aircraft goes up.
Exactly. And because the total supply of aircraft in the world is fixed right now, or at best growing very slowly, the lease rates hold up incredibly well.
The price of the rental goes up.
Or stays very strong for longer durations. And utilization is extremely high. The planes are always flying. They aren't sitting idle on a tarmac somewhere losing money.
And there is a clear nuance here regarding the airlines themselves.
Yes, there is. The leasing companies can win in this environment, even if the airline operators are struggling with their own profitability.
As long as the airline pays the monthly lease, the owner of the asset does well.
Right. It is better to be the landlord than the tenant in a tight market.
That is a great way to frame it. Let's look at the tickers for these landlords. First is AerCap Holdings.
Ticker AER. AerCap is the largest aircraft lessor in the world. They have a massive, diverse portfolio of planes. And in a constrained market, size is a major advantage. They actually have the physical inventory that the airlines desperately need.
Next is Air Lease.
Ticker AL.
AL.
Air Lease is known in the industry for their forward order book. They ordered a lot of planes from manufacturers years ago. Those delivery slots are incredibly valuable assets today.
Because you can't just call up and get a delivery slot today.
Exactly. If an airline wants a new plane anytime soon, they have to wait at the back of a very long line. Or they go to Air Lease and pay a premium for one of their slots.
And finally in this group, ATS Corporation.
Ticker ATS.
ATS.
ATS is deeply involved in aircraft services and maintenance. Once again, the high utilization of the global fleet drives consistent demand for their specific services. Planes flying more hours means more required service intervals.
So AER, AL, and ATS are winning because they either own the scarce physical asset or they provide the essential service to keep that asset moving.
Correct. They hold the cards when supply is tight.
Now we have to look at the other side of the coin. The losers. The companies that are negatively affected by the logic surrounding the FTAI news and the broader constraints.
The first group of losers consists of what we call high multiple narrative momentum names.
That is a very specific category. What does it mean for the everyday investor?
These are stocks that trade heavily on future expectations rather than their current tangible cash flow. They're often called story stocks. People buy them for what they will be in 5 or 10 years.
And why do they end up as losers in this specific scenario?
Because of the very real risk of an expectation reset. When a popular leader like FTAI misses its numbers, it makes traders nervous about other high-flying, high-beta names.
Changes the overall market sentiment.
Does. Traders immediately start to look to reduce their risk. They move away from companies that need absolute flawless execution just to justify their current stock price.
The first ticker in this loser category is FTAI itself.
Ticker FTAI. It is the catalyst for this whole discussion. It showed the market that even a strong company with a great story can miss expectations and get punished.
The next one is Nuscale Power.
Ticker SMR.
SMR.
Nuscale is heavily involved in the nuclear power business, specifically small modular reactors. It is a highly promising technology, but it is still very much in the early stages of commercialization.
So it's a long-term story stock.
It is, and in a market environment that is actively punishing earnings misses, long-term stories can become very vulnerable. Investors might suddenly decide they want to see near-term results instead of future promises.
And the third one here is Oklo.
Ticker OKLO.
OKLO.
Very similar setup to Nuscale. They are focused on advanced nuclear technology. And yes, it is tied directly to the AI power demand narrative we discussed, but fundamentally it is still a story stock right now.
So the logic here is that if the market gets cautious because a darling like FTAI stumbled, these names, FTAI, SMR, and OKLO, can see immediate selling pressure.
That is exactly the logic. It is a rapid rotation out of execution risk.
The next group of losers brings us back to the aviation sector, the airline operators.
Right, and this is the direct flip side of the aftermarket winners we talked about earlier.
How so? Connect those dots for us.
Well, we established that the part suppliers like Heico and TransDigm have immense pricing power right now. That means they can and do charge more for their parts.
And the airlines are the ones who have to pay those higher prices.
Exactly. The airlines are facing severe higher maintenance costs across the board. That inflation eats directly into their operating margins.
And there is also the operational issue of aircraft downtime.
Absolutely. If engine parts are scarce, the planes stay on the ground longer waiting for repairs. A plane sitting on the ground does not generate any revenue.
It creates massive inefficiency in their network.
It does. Less capacity flexibility means the airlines cannot optimize their flight schedules as well. They can't swap planes out easily if one has a mechanical issue. It causes cascading delays and costs.
So let's look at the specific tickers bearing this burden. United Airlines.
Ticker UAL.
UAL.
United has a very large, diverse fleet and is highly exposed to these exact cost pressures. They have to constantly deal with the inflation on the maintenance side just to keep their schedule intact.
American Airlines Group.
Ticker AAL.
AAL.
American is in a very similar boat. They are constantly trying to manage their unit costs, and rising parts prices make that objective much harder to achieve on a quarterly basis.
And Delta Airlines.
Ticker DAL.
DAL.
Delta is widely known for running a very good, efficient operation, but they are not immune to this industry-wide inflation. The baseline cost of keeping a commercial fleet flying is simply going up for everyone.
So UAL, AAL, and DAL find themselves in the loser column because they are the entities ultimately bearing the financial burden of the parts scarcity.
That is the direct financial implication. The cost rolls downhill to the operators.
The final group of losers we need to cover are the commercial aerospace manufacturers.
The companies that actually build the airframes and assemble the planes.
Why are they considered losers in this specific context? We know demand for new planes is incredibly high.
Demand is definitely high, but investor sentiment is very cautious in what traders call a cautious tape.
Because of the execution risks involved in building them.
Yes. Investors are highly worried about production ramp risk. It is one thing to have a full order book. It is another to actually build the planes fast enough to meet the delivery schedules.
And there are constant supplier issues making that harder.
The underlying supply chain is incredibly fragile right now. Plus, there is constant headline risk. Every single time there is a production delay, a quality control issue, or a missing part, the stock reacts negatively.
So investors simply prefer the cleaner, higher margin story of the aftermarket suppliers.
That is the rotation trade in action. It is fundamentally easier to bet on the companies selling the high-margin replacement parts than to bet on the heavily scrutinized, complex manufacturing process right now.
The main ticker everyone knows here is Boeing.
Ticker BA.
BA.
Boeing has had well-documented ongoing challenges, production delays, intense regulatory scrutiny, supply chain bottlenecks. It is a very difficult operating environment for them to navigate.
Next is Spirit AeroSystems.
Ticker SPR.
SPR.
Spirit makes the actual fuselages for Boeing, so they are directly physically tied to Boeing's production rates. If Boeing has to slow down its assembly line, Spirit is immediately affected.
And finally, AAR Corp.
Ticker AIR.
AIR.
AAR is technically in the aviation services and supply chain space, but in a cautious market, they can easily get grouped in with the broader manufacturer sentiment. If the whole sector is under pressure, they can see sympathy selling too.
So BA, SPR, and AIR are facing severe headwinds purely due to the complexity and risk of ramping up heavy manufacturing in a constrained world.
That is the dominant view on Wall Street right now.
So bringing all of this back together,
Right.
we started with FTAI missing its earnings expectations.
And we saw how studying that single event reinforces an understanding of a very specific market structure.
The winners are clearly the ones who can capitalize on physical scarcity. The aftermarket parts suppliers, the power infrastructure providers for AI, and the aircraft lessors who already own the planes.
They hold the leverage because they own the constrained resources.
And the losers are the ones who are forced to pay for that scarcity or who struggle to overcome the physical bottlenecks. The airline operators and the commercial manufacturers.
Plus the speculative, high multiple names that get hit instantly when market sentiment turns cautious on execution.
It is a very clear divide when you map it out like this.
It is. It really shows how analyzing the mechanics of a single earnings report can highlight the broader structural trends happening across the economy.
One final thought for you, the listener, to mull over before we go. We often see these high-flying momentum stocks, and we focus entirely on the grand narrative. But this FTAI example shows the brutal tension between a great story and the reality of execution. It really makes you think about how much of the current market is priced for an absolutely perfect future and what exactly happens to portfolios when reality intervenes.
It is always a delicate balance. Ultimately, execution is what matters.
We will leave it there. Please note that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own research.
Thanks for joining us on Breaking News to Trading Moves. We will see you next time.